My name is Larry Pollack. Good morning and welcome to the 13th annual NYU KPMG Tax Lecture Series. I'm a tax partner with KPMG, a graduate of the LLM program, and director of this tax lecture series. It's my pleasure to be here this morning to be the coordinator of this program. By way of background, this lecture series was created back in 2000 to create a forum that brings together high-level government officials, tax academics from NYU Law School's tax LLM program, members of the bar, and tax partners from KPMG to explore various issues that are of current interest in taxation. The title of today's symposium is Tax Planning for Inbound Investment, Defining the Boundaries. In fact, that's the theme for the program today. Where do we draw the line in the sand with respect to the U.S. taxing jurisdiction over foreign persons, both under domestic tax law and by application of U.S. tax treaties? Through a variety of lectures, panels, and debates, we're going to explore various aspects of inbound investment today along the life cycle of an inbound investment, starting with an initial portfolio investment into the United States, acquiring, financing, capitalizing a U.S. business, restructuring post-acquisition a U.S. group by a foreign multinational, repatriation of the profits from the U.S. back to the home jurisdiction, and ultimately final disposition or liquidation of the U.S. operation. Our keynote speaker today is going to be Danielle Rolfs. Danielle is the International Tax Counsel for the U.S. Department of the Treasury. Following Danielle's comments of later this morning, Danielle graciously agreed to join a debate session where we're going to explore the paradigm of domestic tax law treaty overrides. Are we going against our word? That is it ever appropriate for the United States to conclude a bilateral tax treaty with another country and later in time to enact domestic tax legislation that appears to override what we have agreed with our treaty partner? That should prove to be a very lively debate. Our distinguished speakers today include, representing NYU Law School, Professor David Rosenblum, Professor Daniel Shaviro, Adjunct Professor Willard Taylor, and visiting Professor Carlo Garbarino. Representing KPMG, Sean Foley, Fred Gander, Pat Jackman, Tom Zolo, Marco Grundig, Kees van Meel, and Bastien Voisin. Representing the bar, Richard Anderson of Wilmer, Cutler, Hale, and Dorr, LLP, Peter Connors of Orrick, Harrington, and Sutcliffe, LLP, Patrick Fenn of Aiken Gump, Strauss, Hauer-Feld, LLP, Jeffrey Friedman of Sutherland, Asbill, and Brennan, Peter Gens of King & Spalding, Amik Panda of Sullivan and Worcester. There'll be two breaks, one in the morning, one in the afternoon. Lunch is just after 12 noon. We will be resuming in the program directly following each of the breaks and lunch to keep the program on schedule. Just a few administrative comments on CPE and CLE. In order to claim credit for both continuing professional education and continuing legal education, you need to have signed in at the registration desk this morning and have received your name badge. In order to actually get the credit for CLE, when you depart the program, at the end of the day, there'll be a box where you'll submit your scannable. There is a second ID card, which you'll see here on the screen. This is the paper badge that you'll see. It's inside your name badge. And at the end of the day, you just take that paper badge from NYU and just drop it in the box on the way out at the end of the day. NYU will scan that in, and you'll get your CLE credits. If you should need to leave throughout the day prior to the end of the program, just see the registration desk, and they'll clock you in at the end. NYU is going to email you the CLE certificates in about a week, I believe. For continuing professional education credits, all you need to do is have received your name badge. Now, at the end of the program as well, for both CLE and CPE, you will have to fill out your evaluation valuation forms, which you'll drop in the box on the way out. And one last final comment for CPE. In addition to having just received your name badge and registered this morning, there is a CPE form in your binder that you will need to fill out, and you'll hand out at the end of the program to get CPE. So again, in summary, for CLE, you have this paper name badge, which is on the screen, plus an evaluation form. That's what you need for your CLE credits. For CPE credits, you just need to have received the name badge at registration desk and fill out the evaluation form at the end of the program. As a reminder, please put your cell phones on silent ring. And with that, I'd like to again welcome you to the 13th Annual NYU KPMG Tax Lecture. Now, let's get started. Our first topic this morning is going to be led by Richard Anderson. The topic's going to be an overview of the U.S. taxation of inbound activities of foreign persons. The opening segment is intended as a high-level primer for those who don't regularly practice in this area. And there'll be a focus on where and how does the U.S. draw that line in the sand as to our taxing jurisdiction over foreign persons. Richard is a partner with Wilmer Cutler Hale and Dorr, LLP, and is a frequent speaker and author on international tax matters. In particular, Richard has co-authored or authored treatises covering the foreign tax credit, foreign investment in U.S. real property, and U.S. income tax treaties, and also has authored B&A portfolios dealing with FIRPTA and U.S. withholding tax on foreign persons. Richard has also been an adjunct professor at the NYU Tax LLM program. Richard.
Thank you, Larry, and good morning, everyone. And let me add to Larry's comments my welcome and my thanks to you for coming, particularly at this ungodly hour of 8:30 in the morning. My principal obligation here, in addition to providing the primer that Larry described, is not to put us behind on time. So I do promise that we will keep it brief, we will keep it on time, and we will keep it at a fairly high level. Larry mentioned boundaries as the theme for this conference, and I think that's a useful link to this topic because the question of inbound taxation at a high level of abstraction is really one of jurisdiction. It is a matter of figuring out who out there in the world actually cares that the U.S. in fact has an inbound taxing regime, and what does that mean, and who is affected by it. And so rather than simply give a laundry list of the rules that inform that regime, although we will touch on those to make sure that we all have a common foundation, my objective this morning is to try and set those rules in a little bit of context, taking into account the theme of the conference, which again, as Larry mentioned, is boundaries. So what are these boundaries? And I guess the place to start is who in fact cares that we have an inbound tax regime and who can figure out who's subject to it. And to do that, I thought it might be useful to start by trying to answer this question. What does it mean as a technical matter, as a matter of the statute, to say somebody's a taxpayer? That is a fundamental word, certainly, when you're trying to think about who has obligations under the tax laws. And we don't stop and think very often about what that term actually means. But it has content, and so I thought we'd start there. I've set up 5 examples of types of entities or types of units, if you will. And the question on the table for us to begin with is which among these different entities that I've listed here is in fact a taxpayer under the code. Some of these are going to be easy. I'm trying to get us some easy runway to get started this morning. Not a big surprise that the first item on the chart is a yes. If you are a U.S. corporation, which is in fact an entity that owes tax, and you are entirely domestic in what you do, there isn't a big conceptual difficulty in concluding that the U.S. tax law treats you as a taxpayer. I don't think we have to stop very long on that category. But as a matter of analysis and policy, once you go past that, it gets a little more interesting and a little more complicated. A U.S. partnership is a taxpayer under the code. Not much question about that. And yet, as all of you in the room know, partnerships don't pay tax. So you've already got one of these many examples we see of the Internal Revenue Code being written with English words, but not being written in English. You have a taxpayer. You know, my mother says, if I'm paying tax, that makes me a taxpayer. Well, the code says, not so fast, not so simple. A U.S. partnership has obligations under the tax law. It is a taxpayer, even though in the ordinary course it never writes a check. Things get stranger as we go down this list. A foreign grantor trust. Didn't have to be foreign here, but I was trying to make the point. A grantor trust, many of you in the audience will know this, is a trust that is not treated as owning the assets for tax purposes that it actually owns out in the real world. Its grantor, whoever that may be under the rules, owns those assets. So in a very fundamental kind of way, a grantor trust doesn't exist under the tax laws. It doesn't have the basic requisite of owning something, whether it's income or an asset, that would make it, you would think, a taxpayer. And yet, a foreign grantor trust, as indeed a domestic grantor trust, as a technical matter, and we'll get to why in a minute, is indeed a taxpayer. Going from that to more exotic examples, the government of North Korea, could be any government. The government of North Korea has sovereign immunity, as all recognized governments of the world do, not only under US law, international law, public international law, but also under the laws of almost every other country. And I only say almost because I don't know for sure. And yet, I assure you, and we'll talk about how in a second, the government of North Korea is in fact a taxpayer. I'm pretty confident it doesn't pay any taxes to the US. I'm prepared to make a small wager on that. But it is a taxpayer. There's no two ways about it. I'll show you why in a minute. And finally, you have a foreign corporation here, a corporation not organized under the laws of the United States. It has no visible US connection at all. Doesn't have US shareholders, isn't managed here, doesn't have assets or income here. Why on earth would it be a taxpayer? Well, we're going to talk a fair amount this morning about whether and why and how it pays tax, but it's a taxpayer. So what have we learned from that? What we've learned from that is that essentially everybody's a taxpayer. And that is in fact the rule. The statute in two different parts of section 7701 tells you that explicitly. A person is defined in 7701 as essentially anything you can think of. And a taxpayer is any person subject to any internal revenue tax. Sorry, any internal revenue tax or law. And so the reason why the answer to all of these questions is yes is tied up in those two definitions. If you put them together, then any person that is subject to an internal revenue tax is in fact a taxpayer, in quotes. And if you don't believe me, there are some places you can look. Just as some examples, and there are more, Section 509A deals with private foundations and the excise taxes on private foundations. You look in the definition of a private foundation, doesn't say domestic, doesn't say has to have a charitable purpose in the US, it's a private foundation, wherever it may be. Section 892A3 specifically tells the government of North Korea that it's a taxpayer. It says that if you are a foreign government, you are treated for US tax purposes as a corporation resident in that country. So if the government of North Korea or any other government, for example, owns 100 shares of GE stock and gets a dividend, it's a taxpayer, sovereign immunity notwithstanding. 892 tells you how much tax it actually pays or not, but it's a taxpayer. It's subject to that rule. Section 1461 tells a withholding agent, don't make a mistake, because if you owe me a payment of somebody else's tax and you fail to do it properly, I can come after you for that tax, for that underwithheld or unwithheld tax. Doesn't matter where you are. I may have some practical enforcement problems if I am the IRS, but I have a basis in the statute for saying you're a taxpayer now. It wasn't even your tax originally, but you messed it up, so now it is. My personal favorite is Section 4701. You don't see this very often, but that is a part of the rules governing when debt instruments have to be issued in registered form and what that means and what happens to you when you don't. That provision puts a 1% excise tax on the issuance of a bond that is supposed to be in registered form as we define it and isn't. And there again, It doesn't specify that it has to be a domestic issuer or an issuer with any connection to the US. So there's a whole bunch of governments out there issuing debt who owe us a 1% excise tax on their bond offerings and have no idea. One of the reasons they have no idea is that we're not out there trying to collect it, and we'll talk about that in the balance of this morning's session. So I think I've made the point. Everybody's a taxpayer, including people you don't think are taxpayers, and at a high level of simplicity, we could say, okay, that's going to be the rule. We're going to have a very simple tax return for everybody, 2 lines. First line, what's your gross income? Second line, send it in. The question is, can we run a system that way? Assuming you can, assuming that the statute actually says what I said it said, and assuming that's valid in some way or other, do we really want to tax everybody on everything, everywhere, all the time? I submit to you no, for at least 2 reasons. One is it's not so easy to do. Anybody here wants to call up the leader of North Korea and tell him that he owes us a big check, you go right ahead. Just let me know ahead of time because I don't want to be standing next to you when you make that call. And the other question is, what would happen as a matter of public international law if we did that? What would happen to US investors going overseas? There's 200 countries out there. We have people here trying to invest there. What do you think everybody else does if we start saying, all of you who have no idea we're even here and couldn't find us on a map if your life depended on it, you owe us a whole bunch of money? I think it's fair to say that that is a system that wouldn't work terribly well, and we like to think about the tax law as being a handmaiden of our trade policy. It's something to try and make it easier and more sensible and predictable for US businesses to compete globally, more even now even than before. So if you accept the premise that just because we can do it doesn't mean we should do it, the question is, what do you then do? How do you draw the line, there are those boundaries again, between a time and an occasion and a circumstance when it's appropriate to impose tax on somebody who doesn't live here, and when don't you? Well, there are several highfalutin kinds of principles that the economics departments will tell you are good places to start. One of them is capital neutrality. There's 2 flavors of it, capital export neutrality and capital import neutrality. It's not really important for our purposes to get into the difference between the 2. The principle is really that taxes are an impediment to the movement of capital. And so if you're going to have a tax, and we need taxes, everybody does, then you need to organize your taxes in a way that doesn't overly restrict the movement of capital and the ability to get a yield on it. So one of the organizing principles of international tax generally, and certainly one of the organizing principles of our inbound tax regime, is what is appropriate in terms of taxing capital without making it overly difficult for owners of that capital to deploy it efficiently. How do we keep the tax law from being too much of an impediment? Another set of principles is the equity principles, both horizontal and vertical. Horizontal equity means that similarly situated taxpayers ought to be treated similarly. Now, you can tell any rule that has the word similarly in it twice is going to have a problem, and it does. The whole ballgame here is to figure out how do you recognize when 2 people are similar? Along what lines, what dimensions are you going to analyze their similarity to decide whether you're going to tax them the same way? And we're going to talk about that a fair bit as we go through the substantive rules of inbound tax versus taxing US investors. Vertical equity, on the other hand, is about the ability to pay. And in a sense, fairness in the ability to pay. Should the amount of tax, the extent of your tax obligations be tied in some way to the amount of your connection to the taxing jurisdiction and to your ability to pay? How much benefit do you pull out of your connection to the jurisdiction for which the tax is a quid pro quo? And related to that are the questions of fairness. That do you have enough of a connection can also be viewed as a fairness question. Is it fair to take a very, very small connection to a country and make that the foundation on which you build a very large tax bill? Or is there some minimum amount of connection below which you should not go? Not surprisingly, the answer is yes, but how do you figure out where that line is? And we'll talk about that. those are all very academic and theoretical questions. The very real day-to-day question is, whatever the principles are you choose to organize your tax system, how are you going to collect it? What does an administrable tax system look like? If you have a system that taxes every entity and individual on the planet, how do you deal with the fact that the majority of those, as I said before, couldn't find the US on a map and have no idea what their obligations are? There are, what is it, 6 billion two-legged taxpayers in the world by the definition I gave you a few minutes ago. How do you make that work? How do you even tell them they're taxpayers? Do you tell them they're taxpayers? And because every system that takes money from somebody needs an enforcement mechanism, you don't have to think about it very hard to figure out why that is, that's a resource and that's a cost. How many tax policemen can we afford, and what kind of a system for enforcing the tax laws can we legitimately put in place before it starts eating up the very tax we're trying to collect? What's politically feasible? This goes to the question of fairness, and it goes to questions of diplomacy and so forth. And finally, from a larger point of view, not just tax policy, but the fiscal and macroeconomic regimes that taxes are part of, what's the best answer? What are the answers and what are the lines you draw in the sand that are most supportive of your broader fiscal and macroeconomic policies? So those are all the hard questions when you decide, rightly I think, that we can't tax all the taxpayers out there. So then what do we do? Well, we have to decide two things then. We have to decide who we're going to tax, and we have to decide what we're going to tax. Once we've decided we're going to make distinctions, we have to answer those two questions. And so again, putting the organizing principles down on a more concrete level, the questions on who we should tax go to questions of who is the right counterparty to charge with the social contract of public benefits versus paying for them in the form of taxes. Who benefits from public expenditure, and therefore who is it fair to ask should contribute the funds that those public expenditures are used for? Well, we make a couple of decisions about that, certainly in the case of individuals. We think that citizenship matters. I think if you are a national of this country, we'll talk in a minute about what that term means in the tax law. If you're a national of this country, there are benefits, burdens perhaps as well, but benefits perceived or otherwise to being a national of country X, therefore asking you to contribute in the form of taxes to the public expenditure resources of country X doesn't seem like too big a stretch. Interestingly, most countries don't use nationality, at least of individuals, as a basis for doing that. We do, but it's not hard to compose a sensible paragraph about why that's a legitimate basis. Then there's what I've referred to here as embedded residence. That's not a term you'll find in the code. What I was trying to capture here is the notion that residency has a colloquial meaning, and it also has a legal meaning in the immigration laws. We're not talking about that. Residency in the tax law means a degree of connection to the US and to the US taxing system that makes it appropriate to tax the resident more or less like a national. And we'll talk again in just a moment about what, though, in technical terms, what the notion of an embedded resident actually looks like in the tax law. A transitory resident is basically anybody else, somebody who has some physical connection here, some presence, if you will, but hasn't really put down roots in the way that a longer-term resident has done. And in that situation, we've drawn a line that says it's not appropriate to tax them on the same basis as it is to tax either embedded residents or nationals. And then there's everybody else, people who have no personal connection, and by people I include entities, who have no connection by reason of their individual status to this country, but because what they do is connected here, they get income here, they have assets here, that supports a certain amount of taxation, that is a certain amount of permissible connection, and the rules that we have are designed to try and make those fine distinctions about which one of those rules are appropriate for which category of person. Who can bear the tax? That's the other question we ask. We talked about vertical equity a moment ago. This is there a level of nexus that's so light that it is not appropriate to impose either the full level of tax or perhaps even any tax on a non-US, in quotes, taxpayer? The answer to that is yes, and where that line is drawn has a lot to do with what those rules are. And are we treating the similarly situated taxpayers similarly is the other driver in trying to figure out what subset we're going to apply this to. And on a very practical level, because it's one thing to have a rule, it's another thing to actually have the rule carried out, how do we go about enforcing a tax when it doesn't happen completely voluntarily? We talk about the US in fiscal policy terms as a voluntary tax system or a self-assessment system. I prefer self-assessment because April 15th just came by and I didn't feel quite so voluntary about my taxes. Don't know about the rest of you. But it is true that we don't have people knocking at our doors every April 15th with a gun in one hand and an envelope in the other saying, give me your money. We tell the government what we owe. We have the white pieces in the chess game. We start the process of reporting our income and paying the tax. Not everybody does it right. If they don't do it right, you like to think it's because the world is complicated and they made a mistake. Some people don't do it right for other reasons. But whatever that is, the system has to protect itself, and so there has to be some method of enforcement, which is very easy when you're talking about US taxpayers, not so easy when it's the government of North Korea. So that's a very germane consideration in figuring out how, the list of people whom we are going to subject to tax. The other question is, what do we tax? What's the tax base? What is the appropriate tax base? I mean, how do we measure nexus? What part of your tax base do we staple to the US and say, this is income that we feel we can tax because of something? We'll talk about the something for the balance of the session this morning. And this income not. This income, we don't have enough of a connection to that income to get it. So there's that boundary concept again. And how much income? Do we tax gross income, like the joke I made a moment ago? Probably not a good idea. And if it's net income, is it the same net income for a non-US person as it is for a US person? Here's a hint, the answer is no. And why? Well, by now you're getting to the theme here, right? The thread is that we've made decisions about administrability, about fairness, about collectability, about all those things I talked about a few minutes ago that say there are things that are both appropriate and possible. We're going to go after that, and the rest of it, at least in our judgment, we think is not appropriate and we're not going to go. Is all income the same? There too, the answer is no. We make policy decisions about encouraging some activities as opposed to others, and that ripples through the tax law generally, and certainly in the international tax field and in the inbound field. Those questions create rules that, standing alone as a technical matter, don't seem at first blush to make a lot of sense. But when you put them in a policy context, you see, aha, I understand why they're doing that. It may not be completely coherent from a closed system point of view, but in the broader question, it makes sense. I'll give you an example when we get to interest in a minute. And then, and this is critically important in the international field, what I've referred to as knowability. It's, as a practical matter, and obviously not an academic exercise to figure out what tax base and how much tax. You actually have to be able to figure it out in the real world. You look at your books, you look at your pay stubs, you look at whatever you look at, and you have to figure out what's the right number? What are the right numbers, and what do I do with those? Who's got the information and when is a very germane question when you're looking at taxpayers who are halfway around the world, in some cases may just have found out 5 minutes ago that they are taxpayers, and worse yet, they may be among the taxpayers who actually have a tax obligation. And the question is, how do I comply, assuming I want to? How do I actually do the mechanics of doing it? The system has to help the taxpayer that way and not ask the taxpayer to get blood out of a stone. If you don't know how much income how much income or gain is in a particular payment, then it's very hard to figure out what the tax ought to be. So you have to avoid, in a well-designed tax system, running into situations where you're requiring taxpayers to do things they cannot do, because with the best will in the world, they just don't have the data. And this is a recurring theme in the inbound area, because we always have to think about this, that it's not like most of the people in this room. Most of the people in this room have very significant connections to the US, and in a lot of cases, a lot of the information is spoon-fed to us in terms of what we need to know. We get pay stubs, we get whatever we get 1099s, we get forms that say, you got this payment, you got that payment, you got the other. Oh, and by the way, we told the IRS too, so take whatever action you deem appropriate. And all those things make it easier to put the data together, and we're all sort of used to that, or many of us are. But if you are a, quote, taxpayer who never comes here, but has some connection that requires a tax payment, that's a big challenge. And we have to make sure we don't put ourselves in a position of having, again, too many taxpayers required to do things that we haven't given them the tools to do. So with all of that, where do we come out? Who do we tax and what? We are, in fact, going to get the rules here, I promise. So the who, there's really three categories of the who's. Nationals, and by that I mean not only individuals who are citizens, but also entities that enjoy, if that's the word, US nationality. We'll talk about that in just a moment. We have that concept I gave you of embedded residence, and I'm going to unpick that for you in a minute to talk about what the statute means about long-term type residents who have these obligations. And then there's everybody else. And what do you tax? The what depends on who you are. If you're a national or an embedded resident, as a slight overstatement, but only slight, you owe tax on everything earned everywhere. We have a worldwide system of taxation for residents and citizens. There are things to avoid double taxation. There are exceptions to the rule, but that's really the guiding principle. For everybody else, that's where the bulk of the rules in the inbound area are actually found. These are people where we said, all right, we have to draw a line. It's less than everything and less than everywhere. So how do you decide? Where do you draw that boundary? There's that word again. Well, there have been, I guess there are any number of ways of categorizing it. For today, I've chosen 5. There's income that's derived from a transaction where the rules say that it is the status of the recipient that matters. If the recipient has a relationship to the US, we will tax it. If he doesn't, we won't. The second rule here is the reverse. Sometimes it's not about the recipient, sometimes it's about the payor. If there's a connection between the payor and the US, we'll tax it, not otherwise. Maybe it's not about the people, maybe it's about the thing. Maybe there are transactions in which it's where you find the asset that should govern. Then there's the stuff that, hard as I tried, I could not fit it into those 3 categories. So there are some special rules that we'll gloss over lightly that deal with particular situations that don't respond well to that categorization. And then, as a special category, and this will be a theme for the entire day, treaties are special. Treaties are special because treaties are contracts. And it's really the one place where to some degree, there'll be a debate at the end of this morning about what that degree is, you can change these rules, sometimes in very dramatic ways, simply by agreement of 2 sovereigns. Say simply, it's not that easy to do. But that's one way of organizing the different rules. So let's talk about the who. Nationals is pretty easy. In the case of individuals, we essentially follow the immigration rules. If you're a US citizen, presto, you're a US citizen for tax purposes as well. In the case of entities, nationality really means where are you organized. The act of birth certainly of a commercial entity, of a corporation or a partnership, it's a creature of law, and it's something that happens at the level of a particular public authority. You file a certificate of incorporation, presto, you exist. Before that, you didn't. So as a consequence of expanding the nationality connector to entities, the rules in the US, very straightforward in most cases, their practical applications can be a lot harder, is that if you're a corporation or a partnership and you're organized here, you're a US national, in quotes, partnership. Statute doesn't use that term, it uses the term domestic, but that is effectively what it means. It puts you in the same tax category as a 2-legged citizen. There are some exceptions to that, as I mentioned, and we'll talk about them in some of the debate questions. We'll raise some of them, but for now, that's not a bad general rule. Trusts are a little bit different. Trusts have sort of a semi-entity, semi-contractual nature to them, and so after many years of not quite knowing how you do nationality or residence of a trust, we now have a statutory rule that says that you're a U.S. trust if you have predominantly U.S. trustees and you're governed principally by a U.S. court, which is a little bit of a hodgepodge kind of definition. It's not as clear as the one for commercial entities. That's the bad news. The good news is it's a heck of a lot better than what we had before. What we had before is the rule we still have for estates, which is essentially you sort of look at everything and then you figure out whether it's a domestic estate or not. So we're not done in making a lot of clarity on our definitions. I wanted to stop for a minute on the embedded residence because I've used that term a lot, but if you go looking in the statute, you'll never find it. I was trying to capture two different kinds of residency. The statute actually refers to resident aliens, and for income tax purposes, there are only two ways you can do that if you're a non-citizen. The so-called green card test, which essentially says that if you spend 1 day in the U.S. holding a green card, your ticket to lawful permanent residency in the U.S., you are a resident alien from that day forward, whether you ever set foot in the U.S. again or not, unless and until you formally lose that card, either through revocation or abandonment. And there's a lot of immigration law about how you do that. It's actually not that easy. We've also, in more recent years, drawn an even finer distinction between green card holders who've been here for a very long time, so-called long-term residents, and those who may not have been. This is principally relevant for our anti-expatriation rules, which is a whole nother topic for a whole nother day. But those two universes together are the immigration-related, if you will, half of the definition of what it means to be a resident alien. For everybody else, it's the so-called substantial presence test. Are you here enough? You're not a green card holder, you're not a U.S. citizen, but you can be here enough, and you can be here regularly enough to become, and this is my word, embedded. If you're substantially present here, we're going to treat you like a resident alien, and again, like nationals, we'll tax you on your worldwide income. There's a formula for how you do substantial presence. This is the best thing about it, is that it's pretty objective. The worst thing about it is that whenever someone comes to you with this question, they never have all the information you need. But in that magical place where you actually do have people come to you with all the information that you need, it's a relatively straightforward piece of arithmetic. There are some relaxations around the edges designed to let some people off the hook on the theory that there are reasons you may be here that are different from a conscious choice to become an economic actor here, and we didn't want to lock you into a simple arithmetic test. One of the easiest examples of that is diplomats. If you become the ambassador to the United Nations from country X, you're probably not going to be here forever. You're probably not here because you want to Americanize yourself. You're here because for 5 years your country says you need to be here and you need to sit at the UN. And under the substantial presence test, in the absence of an exception, that would make you a tax resident of the US for the time you were here. That doesn't seem like such a good idea. So we have this concept of exempt days, days you are here in some kind of a status where we choose not to treat you like a resident, and those don't go into the arithmetic. So you can be a diplomat, you can be in some cases a student, there are other categories like that where it's as though you're not really here, even though you are here for purposes of this test. You can also prove that, yes, I was here a long time, and it looks like I'm over the test, but my real roots are someplace else, and I can prove it, the so-called closer connection test. And then once again, you're going to be hearing this all day, rules of this variety are often modified, in fact, they're invariably modified by tax treaties to which the U.S. is a party. If you are one of these people, a national or an embedded resident, if I can continue to use that term, the general rule is you are taxable on your worldwide gross income. That is going to be determined principally under U.S. rules. As I mentioned before, long-term residents have an extra special kind of problem here under the expatriation rules that we're not going to get into, but just remember they're there. Couple of exceptions to that. There is a foreign earned income exclusion. You're a U.S. person and or a significant amount of your income is from performing personal services overseas. If you do it exactly right and only stand on your left leg on Tuesdays, you can actually get an exemption from U.S. tax on some of that income, so that's a bit of an exception. We try and avoid double taxation through a credit system, so you may not wind up paying all the U.S. tax here you might otherwise because you paid some of it to another country. And once again, treaties can change the rules for what is the taxable base. And I won't step on other people's presentations and going into more detail than that. So the general rule at a high level of abstraction, if you're a national or a real honest-to-goodness tax resident, then you are essentially taxable on your worldwide income. And if you're somebody else, you're not. And the not goes to the question of everybody else. And now we get to the meat of the international tax rules. This is the laundry list that I've been trying to avoid going through for too much, of what is the subset of income that everyone else is subject to tax on here in the US. We have drawn several category distinctions to do that. And remember, now we're no longer talking about nationals or embedded residents. We're talking about non-resident alien individuals, non-US people. We're talking about foreign corporations and other foreign types of entities, not the domestic ones. We've left them behind. The statute draws a distinction along the lines I mentioned before about nexus and connection and how much activity makes it fair to bring you inside the boundary of US taxation of a non-US person. At one level, draws the distinction between are you conducting a business activity here or not? And if you are, then you are, in the words of the statute, engaged in the active conduct of a trade or business in the United States. Or as a famous faculty member here coined the abbreviation many years ago, ETB, engaged in trade or business. If you are engaged in trade or business, then you have consequences under this category of income. To be engaged in trade or business, one of two things needs to be true. Either you are conducting some minimum level of regular, continuous, and substantial activity here that generates or is intended to generate income. It's an economic activity test. Or you're not, but the statute magically waves a wand and says, we're going to treat you like you're ETB even though you're not. Now, it's worth pausing here for a second because certainly in the debate this is going to come up. Congress, and to some extent the IRS that implements the will of Congress, has a bit of a tick. And that tick is when it wants to import a rule that applies to somebody else into a new area, rather than rewrite the rule again, it will say, we're going to pretend that somebody who lives in this new category actually lives in the old category. So that way we sort of magically import all those rules. So you get into, we're going to have an example in the debate of that, where things that are manifestly not domestic corporations are said by statute to be domestic corporations. It's not that Congress doesn't understand its own rule, at least not all of it. It's not intended really to change the definition of what it means to be a domestic corporation. What it is shorthand. It's an effort to bring in the tax consequences of being a domestic corporation and applying them, lock, stock, and barrel, to an entity that is not a domestic corporation. The simple way to do that, it's not intellectually rigorous, but it's simple, is simply to say, presto, even though you're a foreign corporation, we're going to treat you like a domestic corporation, and then all these other things happen to you. Now, I raise that here because Congress does the same thing in the concept of being engaged in a trade or business in the US and being ETB. We will find places, I'm going to mention a couple of them in what's left for me this morning, we're going to find places where Congress says, this thing, this income you're conducting, this activity rather that you are conducting, is going to be treated as an activity that means being engaged in a trade or business in the United States. Not because it really is that, but because that way you can suck in the rules that go along with ETB taxpayers and apply them to this new entity. And so we'll talk about a particular example of that in a minute. But absent that, being engaged in trade or business means doing something pretty regular, doing something that resembles economic profit-making activity. So the threshold question is, do you have a US trade or business? That's always a factual determination, except in the odd places where the statute gives you an answer. For example, to the eternal glee of investment traders everywhere, trading in stocks and securities for your own account is not a trade or business in the United States, no matter how much you do it. That's not an intuitive rule. It wasn't always the rule, but it's been in the statute for nearly 50 years, and that is just a very well ensconced exception to what it means to be engaged in trade or business. Absent exceptions like that, any regular, continuous, and substantial economic activity means you're engaged in trade or business. Two things come from that conclusion. One is that you owe a tax return. And in the real world, sometimes that's the most important thing to a particular taxpayer. The other thing it means is that the income generated by that activity becomes subject to a specific tax regime. That kind of income is called effectively connected income effectively connected to the conduct of a trade or business. And in a gross oversimplification, it is essentially taxable like the income of anybody else, of a national or an embedded resident. If you have a universe of effectively connected income, you file a return, you take your deductions, and you pay the tax on the difference. In order to be effectively connected, here's a case where the English word actually means what it means, there really does need to be a connection. And the statute and principally the regulations give you rules for figuring out whether income generated by a trade or business is properly connected to that trade or business and is properly taxable under these rules. And as I said, once you have effectively connected income of a trade or business, you've got a filing requirement, you have tax to pay perhaps, there's reporting, and you are subject to examination. All those wonderful things. Then there's everything else. Remember, these are not nationals, they're not embedded residents. These are the everything else people, and they're not engaged in a trade or business in the United States. Then you're taxed on, with very few additional categories, only this remaining category, fixed or determinable annual or periodical income from US sources. Now this is really my favorite example of English words used in the statute that aren't really English. Fixed or determinable annual or periodical income, right? I will tell you that the category of fixed or determinable annual or periodical income includes, among other things, gambling winnings, which if you stop and think about it, if they were that fixed and determinable, I'm not so sure it would be gambling. And a lump sum royalty payment, which doesn't sound all that annual or periodical to me. And yet, I'm here to tell you, and I don't think I will be contradicted by any of my august co-speakers today, that both of those types of payments, if they are from US sources, are subject to tax under this so-called FDAP regime. So don't get wrapped up in the words. Don't think, oh, I understand the English language, so I know what this means. There's a faulty premise there. Congress isn't using the same language you are. This means other income. Other income from US sources is subject to this different non-ECI taxing regime. In the real world, this means the categories of income that you see on the slide. This laundry list will probably catch 80, 85, 90% of the things that happen out there that are fixed or determinable annual or periodical income. That regime is different. If you don't have ECI, you're not ETB, and this is all you have, you don't file a return, usually, and you don't actually have to pay a tax. Somebody else pays the tax for you. We have a withholding system for that, and you're going to have part of your payment held back from you and paid over on your behalf as a final tax to the US government by whoever's paying you. And that's the end of the story. So you have two very, very different regimes at work here depending on who you are and what kind of income you're earning. So this is all the way back to where we started, right? Not all income is the same. Not all taxpayers are similarly situated. And we have to draw a line somewhere. And questions of nexus and connectedness and fairness and horizontal equity and sometimes vertical equity, are the engine for that line drawing exercise. In the time I have left, I'm going to talk about what these connections are as they actually apply concretely to many of the kinds of income you're going to run across. This is the laundry list. I got almost all the way through my session here without inflicting the laundry list on you, but you knew you weren't going to get away from it altogether. Here it is. We'll try and make it as painless as possible. There are, as I suggested, there are three principal connection categories. There's connections of the payee, there's connection to the payor, and there's connection of the asset. There's a hodgepodge of other things that don't fit in those categories, but they cover a lot. So in the universe of payee connections, these are categories where the question of taxability is driven by what is the connection of the recipient of the income to the United States. Well, we talked about this one 5 minutes ago. Effectively connected income. The person earning it, the recipient, is engaged in a U.S. trade or business that generates income that, under the connectedness rules, is effectively connected to that trade or business. I haven't said a thing about the payor in that sentence. It's all about the payee and its relationship to the U.S. This is an example of that first category. A lot of sales gain, there's really no other simple way of saying it, a lot of sales gain is driven by this principle. Inventory sales are not. Inventory sales are generally driven by where title passes. That's an administrability and convenience rule. Sales that are attributable to an office in the US will almost always be sourced here. That's a nexus exception. There are a couple of other exceptions at the margins for depreciable property and for intangibles. But if you take those special cases, important though they are, and put them to one side, gain is generally speaking a payee connection kind of category for tax purposes. If the seller is resident in the US, it's going to be taxable in the US. If he's not, it won't. Bit of an oversimplification, but that's the general driver. Compensation income. Much compensation income is in fact treated as trade or business income because performing personal services is a trade or business. But sometimes it's not. When it's not, it can be FDAP, fixed or determinable annual or periodical income. It's US source income if the services are performed in the US. Again, services are performed by the recipient of the income, so this is a payee category item of income. And at the margins, and for your sakes, I hope neither one of these categories applies to you very often, foreign currency transactions and transactions in derivatives, fascinating and mind-explodingly complicated at the same time, are largely residents of the payee-driven categories. There are fewer categories that are payor connected, but they have a very, very big volume of transactions covered by them. Interest and dividends are the two principal categories here. Broadly speaking, there are some exceptions to this, but broadly speaking, a US debtor pays US source interest. It's a connection of the payor, not the creditor, that determines the source of the interest income. Interest is FDAP income, so absent an exemption, it's taxable. It's taxable at a 30% withholding rate. This is possibly the classic example of an exception swallowing a rule, because the amount of US source interest on which tax is actually paid is vanishingly small. Why is that? Because we have an exemption. We have the so-called portfolio interest exemption, which used to be narrower than it is now, simply by the passage of time. But broadly speaking, if debt is issued the right way, and the debtor has proof that it's being paid to a non-US person, in the vast majority of cases, there is no withholding required on that income. It is US source FDAP income, no question about it. But before you actually get the withholding agent to write you that 30% check, Congress raises its hand and says, oh, good news, this fits the portfolio interest exemption. Do not pass go, don't collect $200, but we do not have to make you withhold here because we made a choice. We're going to go back to the policy question for a minute. We made a choice here that although we have every right to tax this income, we actually like, as a macroeconomic policy matter, for non-US people to put their money here. We like to borrow their money. All you got to do is read the papers. It's perfectly obvious we like to borrow their money. And one of the ways we make it easy to borrow their money is to make it cheap for lenders to lend to us. And one of the ways we do that is say, If you get $100 of interest, we will take exactly none of it as it goes back to you. There is no tax policy, I submit, there is no tax policy reason for this rule. There is a macroeconomic policy reason for this rule, and that's why we have the rule. But it's FDAP, and it's payor connected. It's US source because the payor is here. These other categories, the asset-connected ones, rents from real property, royalties on intangible property, gains from the sale of real property under our notorious, for want of a better word, FIRPTA statute. If to the extent that the property that throws off the income is treated as connected to the US, the income itself is treated as US source. It's got nothing to do with the payor or the payee. You can have a US source royalty paid by a non-US licensee to a non-US licensor. Happens all the time because the license may say you have the right to exploit the intangible property in the United States. Bingo, end of story. Absent a treaty rule that turns that off, it's US source, FDAP income, and taxable. Gains from the sale of real property. This is a very unusual and important category. It's it's not FDAP, but it's it's presumptively US source property, and therefore the gain is presumptively US source because the statute says so, and that even applies to stock of a corporation if the corporation owns principally US real estate assets. I list a couple of special cases here at the end, and once again, because you're going to be hearing this all day, not just all morning, treaties can have a very significant effect on these rules. But as a very quick Cook's tour, not so much of the rules, although I hope it gave you a foundation for what's going to follow today, but as a way of contextualizing them into the discussions today, that's the high-level introduction to the tax system of inbound taxation for non-US people. I thank you for your attention once again early in the morning. Always a pleasure to be the first person up and see a full house, so I'm grateful for that. And I hope you enjoy the rest of the conference as much as I'm sure I will. Thank you very much.
Thank you, Richard, for those insightful comments, for the primer on U.S. inbound taxation and the discussion on FDAP and effectively connected income. With that as a backdrop, the next topic is income tax treaties. As you know, income tax treaties are intended to override domestic tax law, the laws that Richard has described, in a way that can provide benefits to qualified residents of our treaty partners. And the discussion this morning on treaties is going to be led by Professor David Rosenblum. In addition to providing comments in general with respect to tax treaties and the benefits that might be available, Professor Rosenblum is also going to be discussing certain trends and prospects for the future as in the context of income tax treaties. Professor Rosenblum is the James S. Eustice Visiting Professor of Taxation and is the director of the International Tax LLM program here at NYU. David is a member of Kaplan and Drysdale and served as International Tax Counsel and director of the Office of International Tax Affairs in the U.S. Treasury Department from 1978 to 1981. A frequent speaker and author on tax topics, David has taught international taxation and related subjects at Stanford, Columbia, the University of Pennsylvania, and Harvard Law Schools, and also other educational institutions around the globe. Professor Rosenblum.
Thank you very much, Larry. That's very nice of you to introduce me like that. And thank you, Richard, for a very methodical presentation, which I actually was able to follow quite closely on the statutory rules. I don't think there's any way in the time allotted to approach treaties with anywhere near that degree of organization, and it's just not the way I would operate anyway. So I'm going to approach the topic of treaties in a different way. I'm going to assume a certain degree of knowledge of treaties, and I'm going to talk about what I see as the most important items on the horizon in connection with treaties, and also I'm going to talk about some things that I see coming down the pike. So let's go. Let's start with number one. In my view, as someone who's worked in treaties now for close to 40 years, I think the most important development in the area of treaties has been the advent of mandatory arbitration, which we now have in four of our treaty, with four of our treaties. Let me put all those up on the board. We have them with Germany and Belgium. Those were the first two, Canada and France. Those of you who follow this, know this, realize that with respect to Germany, Belgium, and France, the advent of mandatory arbitration has had the desired effect, namely that if you put it in the treaty, you never have mandatory arbitration because the competent authorities get serious about resolving cases. But Canada didn't get the memo, and so we've had at least 5 arbitrations with Canada. And finding out about what's happened in those arbitrations on this side of the border, you'd do better trying to find the nuclear secrets of the United States. But if you wander the streets for even 5 minutes in Toronto, you will at least hear, unverified, that the United States has won all 5 of those arbitrations. I do think that it would be highly desirable on the U.S. side for the Internal Revenue Service to have some kind of a report on its experience, because I think it would aid, it really would help, particularly with Canada, for people to know how these are coming out. I've been involved in one of them, and so I have seen it from the inside. For those of you who don't know, I can't resist making this comment, that the United States did something I think extremely intelligent in adopting mandatory arbitration, because we have baseball arbitration as opposed to the arbitration that you find in the European Union. And with baseball arbitration, it has all sorts of quite desirable effects. The way it works is that the two sides, that is to say the two governments, each propose a solution to an issue. And the arbitration panel, which is a 3-person panel, with each government choosing 1 person, and the 2 arbitrators chosen by the governments selecting a 3rd person from a different country. The panel's mandate is to choose between the 2 sides. In other words, the panel does not have the power to either develop its own solution, to compromise, or even to write an opinion. Its solution is simply a number without any precedential value. This goes a long way toward making the process more streamlined and to undermining, or at least addressing, the principal objection to mandatory arbitration, namely that it interferes somehow with the sovereignty of countries in their tax systems. So I'm a big fan of what we have done, and as I say, as far as I know, the only arbitrations that have taken place so far have been with Canada. I do think that arbitration is, today's program, of course, is on inbound taxation. I do think that the arbitration has probably been more important outbound. Partly that's because of Canada, but because Canada is where the arbitrations have occurred, and partly because there are simply more cases outbound than inbound in the United States. One of the things about in an inbound conference that's worth mentioning, just in passing, is that I wouldn't rely on this, but IRS enforcement on the inbound side, with the exception of certain particular industries like the banks, is a lot less, seems, at least to this observer, a lot less vigorous than the outbound. The second most important development that I think we'd have to mention in treaties is the continuing reduction of U.S. tax at source. The United States uses treaties to promote its own view of the world, which is basically a capital exporting view of the world. We can persist in seeing ourselves as a capital exporter, even though we have been not by any means an overwhelming net capital exporter for quite a few years. We now have a 0 rate on dividends, at least in some instances, in 11 of our treaties in force. and I wouldn't be surprised to see that, that extended. So that's quite remarkable, that movement toward reduction of taxation at source. Now, I should make clear, I think Larry said it, that the treaties, of course, trump the code, and in an inbound context, which is what we're dealing with today, we're dealing with investments into the United States. I would say some very, very high percentage of investments in the United States, the treaties are directly relevant. There are cases where you don't find treaties having relevance, but on the inbound side, the treaties are relevant in most cases. We have treaties with something like 65 countries around the world, and there are most people, those who engage in any kind of planning, have either come from treaty countries or invested through treaty countries, which is a subject that I will get to in a second, because planning through treaties to invest in the United States through treaties is a major subject. Let me now say the third most important development is what's going on in the Senate right now. And for those of you who haven't been following this, we have a hold on all treaties, progress of any treaties in the United States Senate. It has been put on by Senator Paul from Kentucky. I've heard rumors, but I really don't know exactly why he's done this, nor do I know when, if ever, he would remove that hold. But as a result of that, there are a bunch of treaties, an accumulating bunch of treaties, that are stalled in the Senate. And I've listed the ones that I know of. I make no claim to being current with respect to everything, but the tax treaties that are up there are with, treaties or protocols, are with Hungary, which is very important. I'll say a word about that in a second. Luxembourg, also quite important. Convention on Mutual Administrative Assistance in Tax Matters. The new treaty with Chile, extremely important, only our second treaty in South America. The protocol with Switzerland. The Swiss can't understand why we can't get a protocol through that we pounded them over the head to negotiate. And coming soon, Spain, Japan, Poland, who knows? It really is, I suppose it's unfortunate, it's sort of striking that one person in the Senate can basically bring this program to a halt. And now let me just say about some of the ones that are there. Hungary, of course, which is a treaty that is near and dear to my heart personally, since I actually negotiated it. Hungary lacks a limitation on benefits provision. And so it has been commonly used by investors from countries that don't have treaties with the United States, for example, Brazil, to invest through Hungary into the United States and take advantage of the provisions, the lowering of tax under the U.S.-Hungary treaty. In my own defense, who knew that a treaty that was negotiated with people having those funny red stars on their hats, and some of them carrying submachine guns, that country would turn itself years later into a tax haven, but that's precisely what happened. And so Hungary has been reached out and attracted a lot of investment not only from non-treaty countries, but also there's a fair amount into the United States from Canada. And that treaty is, the protocol that's up there would put a stop to that, but again, it's stalled. I want to mention Chile because the only other treaty in South America that we have is with Venezuela. It actually functions reasonably well. You'd be quite surprised, notwithstanding the newspapers. But the one with Chile is important because there is a lot of growing economic activity in South America, and also a lot of attention being paid to tax systems in South America, and it would be very good to get that treaty in place. The protocol with Switzerland brings in a modern exchange of information provision, which we've never been able to have previously with the Swiss. And that's, of course, a very important treaty in the context of all the attention that's been paid to overseas accounts and attempting to to get information out of the Swiss financial institutions. So in any event, I don't know where that's going, but the current status of treaties in the Senate has to rank as one of the important items going on with respect to treaties. Now, looking to where we are in the realm of treaties, I think that one doesn't have to have a crystal ball to see that the whole question of treaty shopping or tax treaty abuse or borrowing treaties it always has been a big issue, and it's going to be a much bigger issue. In the first place, we have a triumvirate of case decisions on treaty shopping. Quite apart from the limitation on benefits provisions that are in all modern U.S. treaties, we also have three, if you will, common law of taxation cases that do not have a specific statutory predicate for challenging treaty shopping. And they are Aiken Industries, Northern Indiana Public Service Company, which I like to people refer to as NIPSCO, and Dell Commercial. And the history of this, Dell Commercial is already about 10 years old at least now, but the history is that Aiken, of course, was under the old treaty no longer in existence with Honduras, and Aiken was, because it relied on specific language in that treaty to deny the benefits of the treaty, it was not clear whether Aiken was a statement of what would become a broad anti-treaty shopping principle, or whether it was a specific interpretation of the narrow language of a particular treaty contract. And we thought we had an answer to that when NIPSCO came down, which involved the Antilles Treaty. NIPSCO, which is a decision that I think is somewhat difficult to understand, but its result is not difficult to understand. NIPSCO comes down saying that Aiken is basically a narrow decision. It upholds the use of Netherlands Antilles finance subsidiaries, and it looks after NIPSCO as though the treaty shopping that was absolutely common, very common in the multinational community, would continue to be accepted as legal on the basis of a fairly flimsy business purpose, which looks to all intents to be saving U.S. taxes as a business purpose. In any event, NIPSCO is a taxpayer-favorable decision, and after NIPSCO, I think those of us who follow this closely thought that Aiken had been put to rest. But no sooner than that had come down than just a few years later, the Dell Commercial case came, decided by a judge at the appeals level by Judge Santel, and Dell Commercial is a situation with a Canadian investor, an ultimate Canadian investor, investing into the United States through a chain of Netherlands and Netherlands Antilles intermediate entities, claiming an interest deduction and zero rate of interest because under the U.S.-Netherlands Treaty, and under a step transaction analysis, business purpose analysis, but really step transaction analysis, I think, if you want to separate those two concepts out, the court comes down saying that the government wins. So all of a sudden, what looked to be a fairly clear playing field for planning to borrow treaties and take advantage of treaty benefits, all of a sudden was impeded by Dell Commercial. Now, Dell Commercial, like Aiken, but unlike NIPSCO, involves all related parties. So perhaps that's a ground for distinguishing Dell Commercial. There has not been, to my knowledge, any subsequent decision that has told us where we're going with this Dell Commercial case. But what is happening independently of Dell Commercial is that, and some of you may be aware of this, that the economic substance doctrine has begun to eat the entire tax law. So those of you who've been following what's been going on in the tax court lately, and indeed in other courts, not just the tax court, we have entered into an era when cases seem to be decided not on the basis of statutory provisions, or indeed, as far as I can tell, on the basis of law, but on the basis of something vaguely described as economic substance, whatever that means. And I have long spoken from this podium and elsewhere about the foreseeable train collision between the economic substance doctrine, which has had basically a domestic birth and a domestic development throughout, ever since it came down with Gregory v. Helvering, and treaty shopping. It's as though you have these two lines of cases where you have the international planning, inbound planning, which I think is still very, very common, and borrowing of treaties on the one hand, and you have some cases which suggest the Bass case. There are a couple of cases that have been decided quite a few years ago which suggest that treaty shopping, let's use a less pejorative term, treaty borrowing is an acceptable practice with fairly minimal presence in the intermediate countries on the one hand. And on the other hand, you have this rising chorus brought on largely by the tax shelter, domestic tax shelter litigation in the United States, and not involving cross-border transactions, involving mostly deductions or credits, but inside the United States. And you have this development of economic substance. Well, that, I don't think those two lines have yet crossed, but they, to my way of thinking, they've been converging for some time. And there are a couple of straws in the wind that I would signal to you. One, in the recent, very recent, Bank of New York Mellon case, which is a foreign tax credit generator case involving the so-called STARS transactions, which are a Barclays Bank generated transaction that's being litigated in, I think, 6 different courts in the United States right now. In the Bank of New York Mellon case, which came down probably about 3 weeks ago, there is a piece toward the end of it where the court, the tax court, says that the treaty is, this is the treaty with the United Kingdom, is unavailable to resource income because the entire transaction lacked economic substance, and treaties are not, you're not entitled to treaty benefits if you have a transaction lacking economic substance. And I suppose at some degree of generality that's true. What was interesting to me was mentioning the word treaties in the same sentence with the word economic substance strikes me as sort of a harbinger of things to come. Secondly, in the even more recent case, I think it came down within the past week, of Barnes Group, which is a tax court memorandum case decided by Judge Gokey, and which does not involve treaties. Judge Gokey applies a step transaction analysis to find that a taxpayer that thought it had made an investment in U.S. property under Section 956, but with a zero basis property and therefore had no inclusion, that in fact all the intermediate steps in that plan could be factored out, with the result that instead of a 956 transaction, we had a 301 dividend. Now that in and of itself, it has nothing to do, it is cross-border, but it has nothing to do with treaties. But in the context of that, of discussing the step transaction doctrine, I was interested to see Judge Gokey cite Dell Commercial. So I really do think that there's much more to come here in this area, that we're going to be seeing controversy and litigation, and in my experience, a lot of the inbound investment which borrows treaties shall we say, has not got a robust presence in the intermediary countries. I don't think anybody investing in the United States through Hungary is employing hundreds of employees in Budapest. But I do think we're going to be seeing something along those lines. All right, let me go to a couple of other things that I want to talk about. Beneficial ownership. I don't know what's going on this now, but I do think the law is somewhat confused. This is an area that I try to follow as best I can. We now have, this has all been thrown up in the air insofar as the United States is concerned by the rules, which I think are pretty good rules by and large, on fiscally transparent entities. We now have a provision in the U.S. model. It's paragraph 6 of Article 1 of the U.S. model. And by the way, I would expect us to be seeing a new U.S. model in the not too distant future. We have a fiscal transparency rule. Fiscal transparency rule, it tracks section 894 of the code and has made its presence felt in a number of negotiated U.S. treaties, and it basically goes with the proposition that the decider as to what we're dealing with is the country of residence. So under fiscal transparency, under 894, residence country rules, if the residence country sees its resident in taxes, the U.S. as source country accepts that. And that's basically the lesson of 894. It's also, of course, the animating proposition in the OECD's partnership report, which is very similar to and based on Section 894. But beneficial ownership is different, and there is this confusion because under the treaty, under paragraph 2 of Article 3 of the U.S. model, as also under the OECD, terms that are not otherwise defined are left to the source country. And if we end up with letting the residence country have the call on who derives the income, which is the proposition in the fiscal transparency rule, who derives the income being decided by the country of residence, whereas the beneficial ownership being decided by the country of source, we are going to run into some serious technical problems. And I don't believe that has satisfactorily been worked out. Certainly it hasn't been worked out in the U.S. model or the model technical explanation. I would add that outside the United States, and this is sort of independent of my first point on beneficial ownership, outside the United States, beneficial ownership has come to take on a much broader meaning than we have ascribed to it in the United States. We have in our treaties the limitation on benefits provision, which is designed to provide something of a defense to treaty shopping. Most countries of the world, this is a US originated idea, most countries in the world do not have that, although I believe the Japanese, with whom we negotiated fairly recently, have begun to put something like it in their own treaties. I haven't followed that closely, but I'm so informed. But broadly, we have limitation on benefits, and that allows us, although we don't articulate it this way, to interpret beneficial ownership in a fairly narrow way, as meaning something like whose income is it really? Are we dealing with a nominee? Are we dealing with an agent? Or are we dealing with a real owner? That's the way we look at it. It's not the way the rest of the world is looking at it. They don't have limitation on benefits, so they are moving in the direction of expanding beneficial ownership to test situations where, for example, income is received and then immediately passed on to the owners of the entity that receives the income. We saw a case, Prévost Carr in Canada, which is a beneficial ownership case, which I thought was correctly decided, which said that just because income was passed on did not mean that it was not beneficially owned by the original recipient. But we've seen a number of other cases, Indo Foods in the UK, Royal Bank of Scotland in France, There have been several cases out there. There's a Spanish case, there's a couple of Spanish cases, all questioning whether when a recipient passes on income that it receives from a source country, that the question is whether that recipient is in fact the beneficial owner. And I think that is going to be an issue that U.S. companies are going to encounter abroad. It probably is not as directly relevant to our topic today of inbound, where we have control over the issue. Permanent establishment. This is, there's an unending series of permanent establishment issues. As many of you may know, the OECD has put out quite an interesting pamphlet identifying 25, no fewer than 25 permanent establishment issues under the OECD Model Convention. That's a very interesting document. The ones that I think, that at least I see, and that come up with some degree of regularity, I've listed 3 of them. I don't mean to be comprehensive in this. These are just the ones that I've seen with some frequency. Seconding of employees, which is a practice which is quite common. Many foreign companies frequently send their employees into the United States on some kind of a detail, whether it's a formal secondment or exactly the terms can vary from assignment to assignment, but the point is that a foreign parent company may send employees to help its U.S. subsidiary in one of several ways. Those employees may stay for a while. They may become employees of the U.S. subsidiary. Of course, there are transfer pricing issues associated with this, but the one that I want to focus on is whether the parent company subjects itself to permanent establishment status when it sends those employees in. In the cases I've seen, there's very little doubt that, for reasons that Richard has already explained, there's very little doubt that there is a trade or business because you have people performing personal services in the United States. And the question whether there is a fixed place of business available to these employees becomes quite difficult, and quite difficult to analyze. Personally, I find the OECD of limited assistance from a U.S. perspective in reaching those determinations. And I've recently had occasion to hear a discussion at the D.C. Bar of the seconding issue from IRS people at the national office, but I did not get a great deal of meat out of that. I think this is a troublesome area. The reason that it hasn't gotten more attention is because of something I said right off the bat when I started speaking, which is that I don't think IRS enforcement has been all that vigilant on these issues. But I think this practice is common, and I think it is somewhat problematic. E-commerce, I'm sure e-commerce is a huge issue with probably more with outbound than inbound, but it could be also with inbound. The problem with e-commerce that I've seen is whether a server situated in a particular jurisdiction constitutes a permanent establishment. And then one of the problems associated with that is simply identifying what kind of income is being earned by the person operating that server. And you have a variety of candidates. You have rental income, you have services income, conceivably you even have royalty income. There's a lot of potential ways of looking at e-commerce under the rules that Richard outlined. We have in our law, we have very little to deal with. The only case that I know of that really helps at all, and it's all of 2 paragraphs long, is the 1942 case of Piedras Negras. Needless to say, it's a little out of date for this. I don't think there's been a really sophisticated analysis, certainly not in any court, of how to treat e-commerce for purposes of the permanent establishment rules. Agency issues are also extremely common. You have many situations where you have people doing things in the United States on behalf of foreign persons. And although, as I think we all know, an agent, whether dependent or independent, can put a foreign person in a trade or business under our statutory rules, I think that's reasonably clear. What is less clear is how you deal with the treaty analysis, because the way the treaties work, agents, all agents, are permanent establishments if they have the ability to conclude contracts on behalf of or in the name of, depending on your treaty, the foreign person, unless they are agents of an independent status acting within the normal course of their business. So it's not, contrary to what people normally think of, it's not a dichotomy between independent agents and dependent agents. It's a dichotomy between independent agents and all other agents, except those who lack the ability to contract on behalf of the foreign person. And that issue, well, the independent agent issue, we do have guidance in the form of the Taisei opinion involving the U.S.-Japan treaty. But if you're not in an independent agent situation, the question of what it means to conclude contracts in the name of the foreign person is very much of a live issue and very unclear. I had personal experience, not in the United States, but in Canada, with a case that explored that kind of issue, and that may actually be of help in a US case. It's called Knights of Columbus, where Knights of Columbus had hundreds of agents, Knights of Columbus being basically a life insurance company, had hundreds of agents running around Canada selling life insurance policies, and it was found in that case, and I think correctly so, that they did not have the ability to conclude contracts in the name of the enterprise. I think there's some analysis there which could actually be relevant in a US context. So those are three types of issues that I see. There are doubtless many more that I'm just either not coming to mind or I haven't seen. But permanent establishment is a perennial issue under our treaties. Now, I wanted to talk a little bit about a couple more things. Arbitrage is, of course, the taking advantage of differences between two systems. Tax arbitrage is two tax systems. International tax arbitrage is tax systems in two different countries. And I speak and write a lot about arbitrage, but arbitrage is mostly not a treaty subject. It's mostly arises from differences in statutory law under two countries, and since taxpayers can always turn their back on a treaty and say, I want to be taxed, at least a US treaty, I want to be taxed under statutory law, the treaties don't usually enter into it. But there is also arbitrage in a treaty context. And I don't think this is the only situation that this can arise in, but I have seen it, and I know it's fairly common with Luxembourg. Luxembourg is a very, how shall we say, pliant jurisdiction. It likes to help taxpayers. And Luxembourg's rule is that you can have such a thing as a deemed permanent establishment in another country. And you can have it, for example, if you have a US partnership. And that partnership could, for example, be engaged in an activity that is so minimal or so singular in one-time activity that it doesn't even arise to a trade or business, for example, a single loan. My understanding is that Luxembourg would treat such a situation as there being a permanent establishment in the United States. And of course, under their exemption provision, they would exempt the permanent establishment from tax. The United States, on the other hand, US-Luxembourg Treaty, existing Luxembourg Treaty, has a zero rate of tax on interest paid unless it's paid to a permanent establishment. So the question would be, can something be a permanent establishment for Luxembourg purposes and not even be a permanent establishment for US purposes And embedded in that question is the question whether it is possible to have something that is a permanent establishment without being a trade or business under U.S. law. I would have thought not, but I have not found anything conclusive on that. And I know that there's been a certain amount of planning to take advantage of what amounts to a double exemption. No tax in the United States because it's zero rate of interest and no permanent establishment in Luxembourg. No tax in Luxembourg because it's a permanent establishment and they exempt. Beautiful, isn't it? All right, let me go to another issue, which is slightly, again, this is slightly different from the inbound. I guess I exceeded my mandate in thinking about treaties. This is the question of what is a treaty benefit. This is a live issue. Somewhat surprising to me. It is really not an inbound issue, so I probably am not justified in spending too much time on it. But the issue involves Section 1H11 and the qualified dividends provision of the Internal Revenue Code, which now gives a 20% tax, allows a maximum 20% tax on dividends from qualified foreign corporations, in addition, of course, to domestic corporations. It used to be, prior to December 31, it was 15%. And the live issue here involves what does it mean to be a qualified foreign corporation? The statute seems to say, or says actually, that as long as we have a treaty with the foreign country, and the treaty contains an exchange of information provision, and the taxpayer would qualify for the benefits under that treaty, the entity is a qualified foreign corporation. The Revenue Service is in the process of challenging quite a number, I think, of cases involving whether an entity is a qualified foreign corporation. A number of those I know involves the treaty with Cyprus, which I'll come back to in a minute, and which has got a somewhat unique provision on limitation on benefits. But I'm not going to talk about Cyprus. I'm going to talk about Switzerland, because there's also issues under Switzerland. The U.S.-Swiss limitation on benefits provision has in addition to being quite an elaborate provision, it's got what has come to be in a number of U.S. treaties, it's got a special rule for a foreign branch of a third country branch of a Swiss corporation. And the third country branch of the Swiss corporation amounts paid to that do not qualify under the limitation on benefits unless the tax imposed by a combination of Switzerland and the third country amount to at least 60% of what would have been paid if the amounts had been paid directly to Switzerland. So there's a special rule where you have, let's call it a Swiss corporation with a Hungarian branch, or a Swiss corporation with a Bahamas branch, or whatever you want, a third country branch. Now, the problem arises because in many of the cases that I have seen, there's no question of actually taking advantage of the treaty that's being analyzed. In other words, the U.S. person, U.S. individual, is getting a dividend from a foreign corporation and claiming the reduced rate of tax on the dividend, and the Revenue Service is saying, well, we don't think that's a qualified foreign corporation because of the limitation on benefits provision. And the reason that they're saying that, as far as I can tell, is that they have adopted a hypothetical test. And they're not asking whether the entity has actually benefited from a treaty. They're asking whether it would have benefited from the treaty. And unfortunately, the conference report to the statute does use the word would, although the statute does not. And on the basis of the word would, the Revenue Service seems to have erected a test which I'm not sure whether this is where they're going, but it could be as broad as, could one conceive of situations in which the limitation on benefits provision would deny benefits? And if you have a Swiss corporation with a branch in a third country, one could conceive of that happening, even though it may not be happening in the actual facts. Any event, this has all gotten quite confused, and the reason I situate it here is because the service, in order to make this work at all, has to say that the benefit of the reduced rate of tax is a treaty benefit, because that's what the statute is aimed at. The statute says, would you be entitled to the benefits of a treaty under a treaty with another country? I think the whole area is, I mean, it's Alice in Wonderland as far as I'm concerned, but I can't deny its existence. It is a live issue out there. All right, now in my, I think this is my final, I've talked a lot already about limitation on benefits. I want to say two things in wrapping up on it. One, we made a decision, and I think we made it probably back in 1992 with the German treaty on the limitation on benefits provision, which has got a lineage going all the way back to, well, all the way back to my time in the Treasury in the late 70s. We started putting these provisions into our treaties and into our model treaty. You could trace it actually back to the 1975 treaty with the United Kingdom, where the provision was pretty rudimentary. But at a certain point, and I do think it was 92, we made a decision between two paths. One was to do something general, facts and circumstancy, touchy-feely, is this abusive? Sort of abusive law kind of a concept. We know it when we see it, if you like. And that kind of approach we do find in the treaty with Cyprus. Cyprus has got a limitation on benefits provision, which I think is pretty unique in the U.S. Network, although in fairness, all limitation on benefits provisions in the U.S. network are unique. I don't think any two of them are exactly the same. The Cyprus provision has two ways out of limitation on benefits. Either the Cyprus entity is owned by Cypriots. If anybody knows of any, I'd be fascinated. Or the competent authorities agree that the entity was not formed for the purpose of taking advantage of the treaty. So there's a formed or availed of kind of a rule, and there's a Cyprus residence rule. So, and that's all there is. So it's all based on discretion. It's all based on individual facts. And the one thing I think we can say about the Cyprus Treaty as a vehicle for investing into the United States through treaty borrowing is that it has worked. I don't see, maybe I'm blind, but I don't see many people using Cyprus as a jurisdiction to invest in the United States. It goes the other way. U.S. people using Cyprus to invest into Russia, Eastern Europe, et cetera. But I think the Cyprus provision has been reasonably effective, as far as I can tell. On the other hand, with Germany and then with the Netherlands, where we got truly ridiculous, we began to try to write the Internal Revenue Code into these treaties. And so the Dutch limitation on benefits provision occupies fully 1/3 of the text of the entire convention, which seems a little excessive to me. And these very detailed rules in these conventions, starting with Germany, Netherlands, and now pretty much it'll be found in Hungary if Hungary ever goes through. A lot of our treaties today have got very detailed rules. These tend to provide roadmaps for how to avoid limitation on benefits. And my guess is that they have limited effectiveness, that they basically teach people how to borrow treaties and invest in the United States. I could be wrong, but my sense is that the Cyprus approach is a lot more effective. Now, of course, the argument is that the Cyprus approach is not does not give anybody any certainty. They're at the mercy of the Revenue Service, and I understand that concern. But that's the judgment we have made in terms of which way to go. We've gone in the direction of providing detailed rules. Switzerland is another case where we've provided a very, very detailed provision. We also have a feature of our limitation on benefits provisions, and we've particularly needed this in the European Union, is the, excuse me, the derivative benefits clause, where we give benefits under a treaty even though the recipient of the income coming from the United States, the recipient entity, would not be qualified under normal LOB provisions for the treaty benefits, as long as it can be shown that the owners of that entity would have qualified if they had invested directly. And I understand how we got there. If we have for example, we have a payment to an entity in Germany, all of whose shares are owned by French individuals, let's say. The German entity in a bilateral world, and treaties are a bilateral world, the German entity will not qualify on its own. Let's say it doesn't have a trade or business in Germany. It doesn't qualify under any of the normal LOB criteria. But if it can be shown that the French owners would have had as good or better results if they'd invested directly, then we give the benefits to the German entity. Now that's, I find this kind of interesting because I think that the idea that we should give benefits to that German entity because the French owners could have qualified takes a view of what we're doing with our taxes on foreign persons in the United States, which is quite different than we've taken for purposes of the fiscally transparent rules under Section 894. If you think about it, why would we give benefits to a German entity when it's wholly owned by third country persons on the basis that if they had invested directly, they would have gotten the same benefits? We do that because we say they haven't really gained anything from the standpoint of us as a source country. In other words, we are not giving up anything more to this German entity than we would have given up to the French owners if they'd invested directly. That puts all the burden or the pressure on whether to reduce tax on us as a source country. If, on the other hand, you look at Section 894, which we do with transparent entities, we take exactly the opposite view. We say that we will only reduce taxes at source if we can be confident that the residence country is taxing. We say to ourselves, look, the justification for reducing our tax in a treaty is because the residence country is taxing. That's the basic deal in a treaty, right? A treaty is a contract. The source country reduces or eliminates its tax. The residence country undertakes to avoid double tax. So we say, we'll reduce, now of course there are exceptions, but we will reduce our source basis tax if the residence country is taxing. That's a clear position, it seems to me. But I don't think it can easily be reconciled with the proposition that we will reduce our source country tax if it can be shown that somewhere up the chain, some owner could have gotten as low a tax if they'd invested directly. That disregards completely what's going on in the residence country. So those two policies are inconsistent with one another. And we have drifted into, as we do, we have drifted into each of them independently. And I don't think there's anything much to be said about it or done about it. I just find it very interesting that we're sort of carrying water on both hips and a shoulder. I have come to the end of my comments. I thought there was one question. Did I see a question down there before? I think you did. Yes.
Thank you. On arbitration, is that just a majority of the three, or does it need to be unanimous?
Rules like that, I think, are adopted by each arbitration panel, but I think it probably is a majority. What tends to happen, again, we don't have broad enough experience to make a generalization, but what tends to happen is that third arbitrator has a lot of power. I didn't spend, the actual details, I have 45 seconds, so let me elaborate. The actual details of developing that arbitration panel are quite interesting, because it was never self-evident to me in the beginning that it wasn't that the two chosen arbitrators were chosen as essentially representatives of their countries, and that they would choose a third person, and that essentially you'd have a single arbitrator. That's the way I thought of it. But the Revenue Service said, oh, heavens, no, that's not what we mean at all. We're gonna choose somebody, and they have, to my knowledge, they've been choosing retired U.S. tax, I don't know all the people who've been chosen, but I think they've made an effort not to simply choose people in a representative capacity. However, I think it's inevitable that those people, each of them being chosen by the United States and Canada, because that's the real world, it's inevitable that you're going to end up with representation of the positions of those two countries. So that as a practical matter, you are going to get 2-1, and the decision is going to be decided by the third person. Thank you very much for your attention.
Thank you, David, for those insightful comments on tax treaties, and in particular, your observations on the prospects for the convergence of the economic substance doctrine and a tax treaty shopping or a treaty borrowing, as David refers to it, and also your insights on the U.S.-Hungarian treaty, of which Professor Rosenblum has negotiated. Before we run off to the morning break, just a few comments. First of all, the break is going to be located across the hall in Greenberg Lounge. I encourage you to come back in quickly because the next panel is going to start at 10:30 with introductions at 10:25. That panel is going to be on the OECD application of attributing income to a permanent establishments. Finally, we will be having a debate session, as you know, later this morning, together with Danielle Rolfson and other participants, and it will be somewhat audience interactive. If you wish to participate in the polling aspect of it, the audience polling, there will be 150 handheld polling devices available by the entrance to the auditorium. So when you exit or come back in, if you wish to participate in that, just grab one of those and come back in. We'll see you shortly. Thank you.